Hi, I'm the Brazilian investor, literally from Brazil. Today's video is about Vale. Esqueci que sou brasileiro. Vale. We're going to talk about its fundamentals, strengths, weaknesses, starting with a quick look at Vale's history. But before we begin, a quick disclaimer. This video is for informational and educational purposes only. It's not a stock recommendation. I'm not a licensed financial advisor. Do not make your investment decisions solely based on an amazing YouTube video. Do your own research or consult a certified professional before making any investment decisions. Well, let's talk about Vale, one of the largest iron ore producers in the world. The company was founded in 1942 in the state of Minas Gerais, Brazil. It started with the acquisition of large land areas by foreign capital, which naturally led to the creation of a railroad and the beginning of iron ore exploration. When Brazil came under the leadership of Getúlio Vargas, all mining operations were nationalized, leading to the creation of the state-owned company, Companhia Vale do Rio Doce. In the 90s, Vale was privatized. Today, there is no single controlling shareholder with significant influence. This reduces governance risk, increases transparency, and better aligns management with the interests of all shareholders, including minority investors. Fun fact, Vale means value, so I can literally say does value have value? Vale algo, vale a pena, vale tem valor. Anyways, we're looking at a company with decades of history that has managed to survive the test of time despite operating in a cyclical industry. I wouldn't call it exactly resilient, but definitely a survivor. Vale is currently one of the top global players in iron ore production, holding the number 2 spot with about 20% of seaborne market. On top of that, Vale is the world's largest producer of iron ore pellets, allowing the company to charge a premium price due to the high quality of its ore in its pellet products. Something that, for example, companies like CSN Mineração here in Brazil can't fully match. In nickel, Vale is the world's sixth largest producer, and in copper it ranks among the top 11 in global copper reserves. For those who don't know, about half of Vale's revenue comes from China. Another 18% comes from Asia ex-China, 12% from Europe, 11% from South America, with the rest spread across smaller markets. So there is a strong dependency on China, with 50% of Vale's revenue tied to that country. Yes, the company does expect China's share of its revenue to gradually decline over time, but they should be offset by growth in other regions. Also worth noting, most of Vale's revenue still comes from iron ore, with copper, nickel, and other products making up the rest. Vale produced nearly 330 million tons of iron ore in 2024 and expects a similar output this year, with moderate production growth starting in 2026. So, despite its already massive scale, Vale does plan to grow production. It's true that iron ore demand in China is expected to gradually decline, not in a sudden drop, because there is an ongoing rebalancing in steel consumption. In other words, China is adjusting how and where steel is used within its economy. Over the past decade, China's steel demand was heavily driven by real estate and large-scale infrastructure projects, bridges, roads, buildings. But with the ongoing real estate crisis in China, this type of demand has fallen. Steel demand is now shifting towards renewable energy infrastructure like wind turbines and solar panels, electric vehicle manufacturing, and high-tech industrial projects. Meanwhile, other countries are increasing their demand for steel, which should help balance the global market. In the long term, this even points to a potential increase in global iron ore demand, although in the short term some volatility is expected. Forecasts suggest that between 2024 and 2030, China will lose about 145 million tons of iron ore demand, while other markets will grow by 120 million tons, almost fully offsetting China's decline. So it's not really a problem. The company will not vanish over this. Another highlight is Vale's production cost leadership. While Vale's peers are seeing increases in their production cost per ton, Vale is expecting its third consecutive year of cost reduction. By 2026, the company targets production costs below $20 per ton, with further reductions planned by 2030. This focus on efficiency is crucial for a cyclical company like Vale, which has no control over the market iron ore prices. They can spike or crash without a warning. So Vale is focusing hard on what it can control, costs, and is doing a good job. Beyond production costs, Vale also has other operational expenses. For the short term, total costs per ton is expected to decline. For 2025, management expects total costs between $53 and $57 per ton, dropping further to between $50 and $54 by 2026. Even at these total cost levels, Vale remains profitable, generating positive cash flow and paying dividends, especially with iron ore prices currently around $100 per ton. So even with today's lower iron ore prices, Vale remains cash positive thanks to its low cost structure. Another point worth analyzing: Vale's market cap versus commodity price cycles. When iron ore crashes, Vale's share price falls. When iron ore rallies, the stock goes up. High iron ore prices drive higher profits and bigger dividends, and vice versa. From 2016 to 2021, iron ore prices soared, went up. Vale's earnings grew, and so did its dividends. Since 2021, iron ore prices have been falling and dividends have naturally declined, so investors must accept that this kind of stock will always have good times and bad times. In recent interviews, Vale's executives stated that they're not interested in extraordinary dividend payouts, not at the moment, mainly due to global macro uncertainties and major short-term cash outflows related to Brumadinho and Mariana disasters. The company made mistakes and will face consequences. Honestly, it should have paid sooner. But most of these disbursements will happen in the coming years and should gradually decline over time. Around 15% of Vale's revenue comes from copper and nickel. The company plans to increase production over the next few years. For 2025, there is some growth planned in copper output, and from 2030 to 2035, Vale aims to potentially double its current copper production. So, looking at the mid-long term, copper is expected to become an important growth driver. If copper prices stays favorable, this segment could strongly boost Vale's earnings. In terms of total sales volume, Vale expects an average annual growth of about 3% between 2024 and 2030, considering copper, nickel, and iron ore combined. If prices stay stable or rise, Vale's revenue should grow. As we've seen, the company is intensely focused on cost control and efficiency. So, looking ahead, Vale could deliver earnings growth, increased cash generation, and solid shareholder return, as long as costs stay low and commodity prices stay at sustainable levels. Also, Vale plans to invest around $5.9 billion per year, targeting growth in both copper and iron ore production. Its free cash flow yield is robust, about 10% compared to 5% for its peers. How is it calculated? Vale took free cash flow projections from major foreign banks, divided it by its current market cap, and that gives us this 10% free cash flow yield estimate. This suggests that Vale has room to provide an attractive dividend yield for shareholders, especially since the company tends to distribute a large portion of its free cash flow as dividends. Meanwhile, Vale's peers are unlikely to pay such high dividends due to higher valuations and weaker results. Recently, Vale announced to the market that it received a preliminary license for its Bacaba copper project. Further licenses will still be required for installation and operations, but this preliminary approval reduces regulatory risks for the project. This is a strategic project. It's the first of a series of copper initiatives aimed at doubling Vale's copper production capacity over the next decade. The company said it will invest $290 million during the implementation phase, with production expected to start in the first half of 2028. Doubling copper capacity is undoubtedly a huge long-term growth driver for the company. Yes, execution risk remains, getting the project done on time and on budget. And of course, there's future copper price volatility. Vale has proven over the years to be highly capable and efficient in delivering large-scale projects. Lastly, there is a new management team in place. Following a CEO change, Vale plans to grow at an average rate of 3% per year until 2030. The company remains focused on cost control and reduction, something that could drive margin improvement if iron ore prices hold steady. Additionally, Vale's capital allocation strategy is conservative, emphasizing low capex intensity, investment optimization, and asset reviews. And finally, Vale aims to maintain healthy shareholder returns through both dividends and share buybacks. So, here's what we have: a company with decades of history that has survived both economic crises and commodity price cycles. One of the leaders in its sector. Yes, still heavily reliant on China, but with clear plans for diversification. And even as a cyclical business sensitive to iron ore price swings, Vale is doing its homework. Cost control, expense reduction, operational efficiency, strategic investments, and now a new management team focused on capital discipline and shareholder returns, whether through dividends or buybacks. Of course, the global scenario still poses risks like weaker Chinese demand or overall commodity market uncertainty, but at the same time, Vale's low production costs give it a competitive edge over its peers. In short, Vale's future will largely depend on three things: global demand trends, ongoing cost control, and the management's ability to continue generating cash and rewarding shareholders. And let's remember, the best time to buy cyclical stocks is when the macro environment looks ugly. If you see that the company fundamentals are still strong, it could signal a good entry point. Yes, in the short term, we'll suffer alongside the company, but when the cycle turns, there is a good chance to ride the full wave of profit and dividend growth, or better said, an explosion of profits and dividends. While the stock moves sideways, it's accumulation time. It's buy and hold time. Thank you for watching. Tell me your opinion in the comments. See you next time. Brazilian investor, literally from Brazil, with facts, not samba. Obrigado, forte abraço e até a próxima. For those who don't know, about half of values, values? values